G'day, I'm Connell from Cobalt, and today we're talking about one of the fastest ways to scale a financial planning business, buying an existing book of clients. Whether you're a solo advisor looking to grow or a mid-sized firm looking to expand, acquiring a book can be a game changer. In this video, I'll walk you through why buying a book can be a powerful scaling strategy, how to value and structure the deal, options for financing the purchase, the risks and must-have due diligence, and whether the perfect book actually exists, and a quick comparison between some alternate strategies for growth instead of buying a book. First up, why buy a book in the first place? Simply put, it's an instant way to add revenue, cash flow, and clients compared to slow and steady organic growth. One of the biggest problems we hear from advisors is, or it's more like a cycle that they're trapped in. They're too busy. To get more efficient, they need to invest in money or technology or staffing. However, they don't have the cash flow to spend on the business, so they need to grow to increase the cash flow, and they can't grow because they're too busy. So it's this self-fulfilling loop they can't get out of. Purchasing a book of clients can break this cycle. It can add that cash flow that the business needs, which gives the advisor the ability to invest in the business to solve other issues. However, of course, this isn't a perfect solution. Unlike organic growth, where you attract clients who buy into your business and your brand, bought clients can be their own project in their own right. You need to meet them and bed them down into your business. So deciding if this is the right method for you is a big one, and it's important. The big one is having a think about that increased cash flow compared to that extra commitment in the tasks you're gonna have to do. Book multiples and contract terms. One of the first questions you'll have is, what is the current value of a financial planning book? We've seen it all. I've seen 0.8, I've seen 4 times. The spread is wide. A pretty good starting place at the moment would be just starting at that 2.5 mark, digging a bit deeper, and then deciding if it's worth more or less. I'm sure you've seen Radar results, and if you haven't, have a look. It's a really good resource in their valuations tab. They'll give you some ideas around some variables to consider. Some they'll talk about, and some other ones could include client age. Do older clients get discounted? Service model, are they on fixed term agreements or ongoing? What have the clients been promised every year? Are they 1 review, 4 reviews? Average fee size. That's an interesting one. You'll note some people looking for a higher multiple with higher fees per client, which I agree with to a certain point, but just have a think to yourself. Would you rather 10 clients paying 10 grand a year or 20 clients paying 5 grand per year? Quantity of clients, obviously having less is a good thing, but at a certain point you've got exposure risk. You don't want to lose 1 client and it's 20% of your revenue. Revenue type, of course, is another one. Is it mostly ongoing fees or is it mostly insurance commissions? Risk-heavy books can be lucrative, because they require less upfront time, and everyone has this idea of converting them into ongoing service clients. However, they could be riskier. Again, coming back to those demographics. I find in general that advisors are a bit obsessed with the multiple as a single factor. Just believing if you can buy something for a lower multiple, it's just all round better. However, the terms of the deal can be as important, and they also play a role in deciding the multiple. Think about a book. It's $250,000 of ongoing revenue, 50% ongoing, 50% insurance. Think about how the multiple may change depending on the terms of the contract. What if you were to pay 100% upfront and there was no clawback period? Or what if you pay 80% upfront and there's a 12-month time where you can go back and claw back any revenue lost? What if it was vendor financing and you're only paying a 30% deposit upfront, you're paying monthly installments, and the advisor's around to help you bed down all those clients? Different things matter to different buyers and sellers. Like if you can find a seller that wants a lump sum and you can pay a lump sum, you might end up negotiating a lower multiple. But maybe you've got a person who's selling, they're retiring and they don't need the money tomorrow, and they're happy to stay in the business to help bed in those clients. They may want the higher multiple, more money over a longer period of time. And that's going to reduce your risk too. So these are all the different factors that can, play a part. Financing options, secured, unsecured, and more. One of the biggest hurdles is often financing the purchase. Before I go into different options and before you get too far down the road, if you haven't already, it's time to do some maths. Using a multiple of 2.5 and a 5-year loan period, have a look at the remaining cash flow, especially after you consider tax and other expenses. You're taking on a bit of risk, and you don't want to find yourself marching uphill for the next 5 years. You need to have a healthy cash flow buffer for you to basically succeed with this purchase and grow your business, and then not just be drowning that whole time. So one of the things I generally would say is you're looking for a finance term of at least 10 years so that you have that healthy cash flow buffer. There's obviously other variables that come into play, but making sure you've got healthy cash flow is really important. The first thing that comes to mind when it comes to getting finance for advisors does tend to be, securing the finance against the book that you're buying. There are banks that will do it. If you haven't heard of them, places like Trailblazer or Judo Bank actually do understand the recurring revenue businesses. They'll treat the client book as collateral. Things you want to watch out for there, though, would be high LVRs, high interest rates, and lower time periods. Some of these agreements may ask for a tripartite agreement with your license, which generally shouldn't be an issue for you, them, or the license. However, they could ask your AFSL to pay your loan repayments directly from your revenue, which, again, it's fine. It's just something you need to check on. Be aware of the bigger banks, like the Big Four. They will do some of this business, but what we found is, what's a good way of putting this? They aren't as motivated if the loan amount isn't, $1 million plus. There are some good benefits of doing secured loans against the book. One of the main ones obviously being that you can potentially get your personal assets out of the transaction, but just ask up front if they are going to ask you for a personal guarantee. Low doc or unsecured loans. Some banks will do just generic business loans where they look at your BAS statements to see if you can afford the repayments. If you're just starting out, this may not be an option, but if you've been in business for a few years and can show a profit, this can be a very simple way of doing things. You're not linking it to the book itself, it's the merits of the business that you're currently in. They might have we can do up to 300, we can do up to $500,000. So it's not going to be a solution for everyone, but we found they can be a really good option as an alternative. Vendor finance, or a combination of vendor finance and loans, is becoming more common. This is where you are able to give things like smaller deposits up front. The vendor may let you pay, in monthly installments, or different chunks of lump sums to pay the loan off. This can be really beneficial to you as the buyer. It's definitely something to look at. You just really want to just understand the terms of that agreement. Whichever option you go for, you're going to need a good broker. Going to one bank and being declined, or going to a broker that just puts you in the too hard basket and tells you it's not going to work, I really just wouldn't take that as a answer. You should generally be able to get some kind of solution, some kind of financing. I would do that almost first before you start looking for the book, so you kind of know what borrowing power you've got. We use McIntyre Finance here in Brisbane. They've helped a bunch of our advisors get loans for books or refinance loans for books they've already got. Give them a call, ask for Mitch, tell them that I sent you. Where to find books? Another large part of this process is finding an appropriate book to buy. I've seen advisors spend a lot of time in this area. I'm talking months, if not years. If you're thinking about buying a book, just be realistic about how long it could take to get your financing and then find the book. It isn't a solution to a failing business. It's not going to solve your problem in a month or 2 months. You need to give it some time to really find the right book and bed it down. Of course, you've got brokers. You'll find them by Googling. There are more than a few in the industry. Some of them will want you to pay a fee to be a part of their process. Inter-licensee referrals can be great. If you're under a group with more than a handful of advisors, like a mid-size group, let them know you're looking, talk to other advisors in the group and tell them you're looking. These can be some of the easiest because when you're within the same license, you just don't have as big of a transfer headache. To give you an idea, we have about 65 advisors and we've done maybe 4 internal sales in the last 12 months. They are, again, more common than you think. Industry word of mouth is another great one. It's a bit of work, but it can be a really great resource. Talk to your local advisor community, talk to your BDMs, even just reach out to the advisors who are literally just in your area. The other thing I would say on this is it just can't be one email or one phone call. I have people telling me they're looking to buy a book, which is fine if I've got something on hand, but in 6 months' time, the question is, will I remember them from that one phone call? So yeah, you want to kind of keep on top of the people in your network. If you're still looking, make sure they're aware that you are still looking. We do think some of the best books are never publicly advertised. They are sold off market. So it does, pay to spread the word and keep your eyes open. Risks and due diligence. Buying a book is not just, plugging revenue into your bottom line. You're taking on relationships, compliance risks, potential liabilities. So let's cover a few of the things you should be looking out for. Of course, the first thing everyone's worried about is client attrition. Are these clients that you've just paid for, are they going to immediately leave? That's why you will looking for clauses like clawbacks within the contract. Compliance, again, is another big one. Has the previous advisor kept up on best practices? Are there any red flags in their advice files? Something that you might inherit. You might think, hey, I didn't give the original advice, therefore it's not my compliance risk, which, is correct from an SOA point of view. But even if you onboard some of these clients and all of a sudden they start complaining about insurance they've missed or, an SMSF that shouldn't have been set up for them, you are going to have to solve that problem, and it is going to be extra work. An advisor who is a higher quality advisor doing more compliant work, you're just going to minimize some of those headaches that, they're going to come up, but you're just trying to reduce the amount that do. Revenue verification. Make sure you're happy with how the revenue is verified. Are they trying to sell you upfront fees, or have they just given you a random spreadsheet that they've made? You could ask their dealer group to verify some of the numbers. Service model fit. If these clients expect, high touch, face-to-face service, and you're a fully digital advisor, you might lose some of those clients. So making sure, that whatever they've been promised and how you run your business, there is at least a large percentage of, correlation. Another good question is, where did the clients originally come from? I see books which have been sold multiple times. An advisor buys it, they try to pull out the value and then they sell it, and the cycle continues. Knowing where they came from is important. Fee increases. This is a tricky one to work out, but you can just ask the question, when was the last time clients had a fee increase? Did the advisor just boost all the fees, and just to pump up the sales price? It's not a deal breaker. I think just knowing when that last fee increase, it can really help you work out the maths on, what you think the book will be worth in the next few years and what you can do to it. The finer details. Look, not all of these things matter, but knowing them can help, spot skeletons. And when advisors ask us, our advisors say, hey, can you help me do some due diligence? These are some of the questions that we ask that they don't think to, which would be, who is the advisor? Let's Google them. What dealer group are they on? Which groups have they been on? Is there any kind of history that we can pick up there? What software are they on? What documents come in the files and what are you going to receive? Where are they? Are they in the CRM, or are they literally paper files sitting on a floor somewhere? You're not always going to be able to get all this detail up front, but the more you can, the better. And yeah, the point is you need to do your due diligence, look at financials, compliance files, client demographics. Just don't rely on an advisor that just gives you a spreadsheet. That's not really a source of truth. You're looking for something else. Does the perfect book exist? I wanted to touch base on this because I talk to advisors and it sounds like a great plan and it keeps coming up. They say, Connell, I'm going to buy a book. It's going to be 100 grand of revenue, 200 grand of revenue, something that's small that they can start with. It's going to be an insurance only book, and they're going to call them all and they're going to convert them to ongoing service clients. It's, foolproof. Please don't waste 6 months or more searching for this unicorn. I'm not saying it's not out there, but I am saying that there's a lot of other advisors looking for that similar thing. Beware of insurance-only books, because have they already been pilfered? Also, some of these smaller books, and it may not seem smaller to you, but it can be just generally, a smaller book that's only 50 grand of revenue or 100 grand of revenue. Bigger books who have a strategy to acquire, they can just go and pay cash for these. So just be aware that, if you're trying to negotiate some of these books, or you're trying to, move slowly and do your due diligence, that can be a factor that's going to hamper the negotiations if there's just some other bigger business out there with a bigger checkbook. I know this is a big purchase and it's a risky thing to do. You're just not going to get everything in your favor. The size, the multiple, the demographics, the term of the contract, you should adjust your expectations on some level. Just work out what your deal breakers are and aren't. Alternate strategies. We all have to do alternate strategies in our SOAs, or at least I hope you are. Now is the time to consider yours. What else could you do other than buying a book? Strategically, you should think about this. But also, what if you just find you just can't do it? You can't get the loan, you can't find the book, whatever it is. Going to plan B or plan C will still see your business growing. This is just one example. I'm not saying you should do this. I'm just trying to use some numbers for you to think about what else could you do. So what if instead of buying a $100,000 book at $375,000, which would leave you, $8K of revenue per month, free cash flow per month, what if you instead spent $5,000 per month, every month for a year on an organic marketing campaign? Let's say you spent $5,000 per month on Google Ads. To get that same free cash flow, you'd need to convert, 15 to 20 grand per month of revenue. There's obviously a bit more to it than that, and you've got to consider things like upfronts and ongoings and the value of your business. But there are legitimate other strategies out there, like spending money on organic growth as opposed to just spending a whole lot of money on a book. Okay, so that was just some high-level points on a book purchase. If I missed anything or you have any questions, don't be afraid to reach out to me personally. I do say this all the time. The best resource for advisors is other advisors. Find someone else who's bought a book, or if they've done a marketing campaign, reach out to them. I think you'd be surprised on how much advisors are willing to share. And if you do like these videos, and if you've got any other topics you'd like us to cover, please let me know. Cheers.